Today we're going to be looking at Ifrs 15, and Ifrs 15 is a relatively new standard introduced by the ISB, and it talks about revenue from contracts with customers. It's basically about how you'd recognize revenue as a contractor when a contract is arranged. How do you recognize revenue? Now, from our knowledge, we know that most contracts take years to be fulfilled or to be completed as an arrangement. We could have, let's say, a government or a private sector trying to build a school, a private sector org trying to build a school, or a government institution trying to build a school. Now, the process of building a modern school could take, let's say, 5 years or 5 years, 6 years, that period to completely build the school to taste. And now the construction company has a 1 year reporting period, as mandated that financial statements should be presented yearly according to the IFRS. Now, this with a construction company having, say, 6 or 10 contracts with a period from 3 years to 10 years, that means for the first year, the second year, if it wants to go by a layman's reporting, the construction company won't have revenue for year one, won't have revenue for year two also. So based on accounting, now IFRS has taken care of that on how you should treat revenue for the year, when you should recognize revenue in construction, or rather contracts that take longer period of time, are not just regular buying and selling, that you sell, you get your revenue almost immediately or latest a month when should the credit time facility should elapse. Now, construction takes years, contracts to take years most times, and in the process of this, the company that undertakes the contract has to recognize revenue in its books for the years. It can't just tell his workers, okay guys, we didn't make revenue this year, you guys should come another year and get your payments, get your salaries. Come another year, the next year, the second year, it says, okay guys, we did this second year too, the first contract has not finished, you'll wait, go meet your families, tell them that in the next, say, 2 years we'll pay you your salaries. So that's not how it's supposed to be. IFRS 15 has already set how revenue should be recognized for construction with customers. Now that's a brief intro on why this um, standard is very important. And we won't be taking the regular way of definitions, this, that. We'll be moving straight into the topic, and we'll be taking some common words used in contract, or common words used in IFRS 15. One of which is the term contract. Now it says contract, an arrangement between two or more parties that creates enforceable rights and obligations. Now the areas that are highlighted here are for our use in case we would want to quickly jot down some important things. Those areas highlighted are very important, and it is good we jot them down too. So the second area is, or the second word we're going to be looking at, is customers. And it says throughout this lesson we're going to be using the word customer often, and it's a party that has contracted with an entity. Now the words we're going to be using here, both of them, we should not mix them up. Entity and customers. Entity is basically the construction firm, or I would use construction firm or construction company because that is what our mind goes to when we say contract. Entity is the construction firm, customer is government organization, or the private individual that wants to get the contract done. So it says a party that has contracted with an entity that is the construction firm, to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. The entity's ordinary activities. Now, the ordinary activity of a construction firm is obviously to build, to make roads, to build houses, to build whatever. So that is the ordinary business activity of the entity, of the construction firm. And I won't make mention of some construction firms here, but we know a lot of them. A lot of them are around us. We see them when we pass through the roads, on billboards. So those are the entities we refer to here. Now we move to the third definition, and it says income, and it says an increase in economic benefits during the accounting period in form of inflow or enhancement of assets or decrease in liabilities that result in an increase in equity other than those relating to contributions from equity participants. So now this is the standard definition of income in accounting. Increase in economic benefits arising from, so you can get an increase in economic benefit from inflow of cash, inflow of money, inflow of resources, or enhancement of assets. Your assets, then decrease in liabilities. Once your liabilities reduce, you'd have more money. If the amount you're supposed to pay for something reduces, you have more money to you. Then we move over to the fourth definition, and it says performance obligation. And here we'll be using this term is very similar to Ifrs 15, and we'll be using it often. A promise in a contract with a customer to transfer the cost to the customer a good or service. Either first is a good or service or bundle of goods or services that is distinct, or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customers. Now this is basically story. It's a long note. What it's trying to say, performance obligation is what the contract was meant to do. What is it supposed to do? And in, like I said, building of a school, you could have the school itself as the performance obligation. Once the school is built, the construction company, which is the entity, is paid his money, which in formal terms and accounting terms also is referred to as consideration. So all these words sound ambiguous, but they're relatively easy. Performance obligation is the school, customer the government, while the entity is the construction company. And we move to revenue, and it says income arising in the course of the entity's ordinary activities. Revenue comes from ordinary activities. Revenue is under income, but revenue is from only the word only the entity's ordinary activities. So if the entity deals with selling of clothes, that is its revenue it gets from selling of clothes. If any other income should come in, it might not be from clothes, it might be other things. If its liability reduces and it considers this as income, that is not revenue because it doesn't come from its ordinary course of business. Then we move over to transaction price. Okay. And it says the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or service to a customer. Not the customer is government or private individual, excluding amounts collected on behalf of third parties. Now, the transaction price is the consideration, and the consideration is the value that is agreed upon in the contract as the value of the contract itself. So that's just basically it. Notes, we know that the transaction price is the consideration, and the consideration is the amount that is valued on the contract, on the obligation to be made. So we go down. Accounting rather, requirements for revenue. So IFRS 15 is based on five basic steps that make up IFRS 15. When applying IFRS 15, you must follow this. In fact, you can't do without it because it's part of the standard itself. It's just like you are going to a place and there's only one road. You want to get to that road, you want to get to that place, you have to pass that road. Then it says the 5-step model framework. That's what we call it in IFRS 15. So it says the core principles of IFRS 15 is that an entity will recognize revenue to depict the transfer of promised goods or services to the customers in an amount that reflects the consideration to which the entity expects to be entitled to in exchange for those goods or services. The core principles is delivered in a 5-step model framework. So we'll move to them. And the first is identify. The first thing you have to do when you want to apply IFRS 15, which is called the core principles, 5 core principles, is identify the contract. Step 1. After identifying, it must be a contract. It must be a contract. And we'll take it bit by bit, but it must be a contract. You must identify that it is a contract. After identifying that it is a contract, you'd identify the specific performance obligation in the contract. An example I gave was building of school, and that is a performance obligation that is in the contract. So after identify it's a contract, you identify that you build that school, and that is the obligation that you have to make before consideration is transferred to you, before the amount is transferred to you. Then the third is determine the transaction price. The third step is to determine the transaction price. After you know the item you are supposed to do, then the price, the price of the item, the consideration is supposed to be determined. Then after determining it, you allocate the transaction price to the performance obligations. Now I would give you a scenario of um a contract that has bit by bit performance obligations. Since contracts take a long period of time, and what is often done is that the contract would be broken down into bit by bit obligations that you must perform before you'd receive consideration as your revenue. And now I'll give an example. An example is constructing a road that has a bridge on it. A road that has a bridge, they could break it down into, okay, the bridge component. You build the bridge component this year. If you build the bridge component this year, we don't wait until you build the road and the bridge together. You build the bridge component, you get paid as that after due process is followed. Then the road too, depending on the length, would have also obligations. Okay, from here to here, this is what you do. You get this. From this town to this other town, this is what to do. You get this. From this town down to the final destination, this is what you do, and you get that as consideration. So that is how, if it's given everything at once, the construction company might run out of cash before it even completes the project, um before it gets its consideration too. Now the construction company gets the consideration while the customer gives the consideration, and the customer is the government organization. So, and after allocating transaction price to performance obligations like the bridge and the road, you now recognize revenue when the entity satisfies a performance obligation. So when it's done building the road or the bridge first, it gets revenue after due process. So those are the 5 steps. Identify the contract, identify that it's a contract, identify the performance obligations, the bridge, the road, the main thing in it, identify the transaction price, how much it is, the consideration you get, allocate the transaction price to the performance obligation, allocate the consideration bit by bit to the performance obligations, then recognize revenue when the entity satisfies a performance obligation. So we're done with that, and we'll be taking them bit by bit now. And it says step 1, identify the contract. And IFRS 15 only comes into effect when the first is the parties have approved the contract. Now this is basically like, how do you know it's a contract? First is the contract gets approved, then inside the contract there are rights that have been clearly stated and agreed upon, each party's rights, and there are different laws, different do's and don'ts in the contract. And it says the entity can identify the payment terms for goods and services to be transferred. The contract has commercial substance, i.e. the risk, timing, or amount of the entity's future cash flows is expected to change as a result of the contract, and it is probable that the entity will collect the consideration. This is very important in a contract. You must be able to receive consideration for your work that is done, and consideration is a term used to refer to the price, the amounts of the contract. And if a customer contract does not meet these criteria, revenue is recognized only when either the entity's performance is complete, now it's done, and substantially all the consideration has been collected and is non-refundable. The word non-refundable is very key there. So it's complete. The second one, terminated. Complete, terminated. Second is terminated, and consideration is received and non-refundable. Both of them are non-refundable. That is when revenue is recognized. The former steps we listed is IFRS 15 only comes into effect when these are like the terms or what a contract is comprised of. It must be approved, must have party rights, identify terms of payment, have commercial substance. So we're done with that, and it says the contract has been terminated and consideration received is not refundable. Then a contract does not exist if each party has a right to terminate an unperformed contract without compensation to the other party. Now, if we agree and I have the right to terminate the contract at any time, especially when the contract has not been performed, that is not a contract according to IFRS 15. And it says when there are combination of contracts. Now, how do you treat combination of contracts? And it says this is for contract with. How do you know it? How do you know it is a combination of contracts? Same customer, same time, negotiated at same package. Now, one or two or even more of these can come together, and it will be classified as a combination of contracts that you can treat as one. Consideration to be paid also depends on the performance of the other contract. The goods or services promised are a single performance obligation. We've already given an example of single performance obligation like a bridge. Then when there's a contract, now we're going to be looking at, we're done with when there's combination of contracts. The 1, 2, 3, 4, 5. The 5 of them can come together. 4, 3 can come together, and you say, okay, this is a combination of contracts, and we can treat them together. So it says when there is a contract modification, what do we do? First, we'll be looking at what is a contract modification. Contract modification is any change in the terms of the contract. Any change in the terms of the contract, such as the price of the contract, the design of the contract, the quantity, if it has to do with goods, the timing. So also accounts for this as a separate contract. Now you account for any modification in the contract when a separate contract when it fulfills the following. We'll go down, and when scope of the contract increases because of the addition that are distinct, and the price of the contract increases by an amount that reflects the standalone price of the additional item added to the contract. Now, what this is trying to say is, okay, if I'll give an example of a road now. So a road, if it was given to, I don't want to mention areas now, from say point A to point B, and later the customer, which is the government, says, okay, let's extend the road from point B to point C, so it goes from point A to point C. Now the extension of B to C is an addition to the contract. Now you treat the whole contract as a new contract, as a separate contract. If now the second place goes by increase by an amount that reflects a standalone price. Now the point B to point C is you would treat the point B to point C. A standalone price is, I'm trying to put it in a layman's term now, so a standalone price is the price you could sell a part of an item, like as if it's different, it's exclusive, it's not part of it. So point B to point C is treated as a contract on its own, as a different contract on its own. With that, you would have further simpler explanations down, but I'm trying to remember. I'll try to remember where it is. And it says step 2, identify separate performance obligations. Performance obligations are usually specified in the terms of the contract but could include implied agreements. Now it says, we've already given examples of performance obligations and we're done with that. Usually specified in the terms of the contract, the bridge itself specified in the contract, but could include implied agreements. What are these implied agreements? It could have, okay, after this, after no one will tell you, since contracts could include supply of goods, no one will tell you that after you supply goods you'd bring invoice, and until the invoice or the invoice is delivered, it is not considered yet. That's implied. You don't need to write it in the contract that you must bring invoice. Everybody knows that invoice is part of transactions, so that's just part of it. You could have also delivery of the goods. It could be implied too, that the seller delivers the goods, since it's a normal cost for the seller to deliver the goods. It doesn't need to write it that you must deliver the goods again. So that is what implied means. Implied means it is not written down plainly. It is something that is not written down, but everyone knows that it should be performed. So it says performance obligations are the goods or services themselves, like I've said earlier, in the contract. And it says when performance obligations are satisfied, an entity recognizes revenue, the amount of transaction price allocated for that performance obligation. So I gave an example of the bridge. So when the bridge is done and it's left with the road, the revenue is recognized by the transaction price allocated to the performance obligation of the bridge alone. That amount for the bridge is recognized as revenue by the construction company, instead of waiting for 3 years or 5 years till when the whole project is done. Then step 3 is to determine the transaction price, and it says it is simply the consideration. Transaction price is simply the consideration. Consider this when setting transaction prices in real life practices. So you consider this. If you're a construction firm, you have to consider this while setting the price you charge for the performance obligation. Then we have the variable consideration, and this is basically caused by the third one here, which is time value of money. The constraint on variable consideration, time value of money, non-cash considerations, consideration payable to customers. So you have to consider all these 5 before you set your price as a contractor. Then we go to step 4, and it says allocate the transaction price to performance obligations. Now we're coming back gradually, and it says usually allocation is based on standalone prices. Now I try explain this road issue better. For each performance obligation, standalone prices are prices entities would normally sell a promised goods or service separately to customers. So if it wanted to do point B to point C in the um former example we gave, the price of point B to point C, as if point A to point B was not done, is the standalone price. That is the price that they charge for point B to point C normally, without considering point A to point B as the first stage. That is the standalone price of the road. Then it goes on to say Ifrs 15 suggests but does not require these 3 methods. So you could value them. You could value the standalone price by the adjusted market assessment approach, expected cost margin approach, and residual approach. Market assessment, basically the market value. Cost plus margin, your cost incurred plus the amount you want to receive as profit. Then the residual approach, the balance of the contract left, dividing the contract into percentages. Then step 5, recognize revenue when the entity satisfies each performance obligation, and this is the last step you do after allocating it. Now when you satisfy the performance obligation, you recognize revenue then, and it says revenue is recognized when the promised goods or service is transferred to the customer. That's it. A transfer occurs when the customer obtains control of goods or services. The benefit and control from the assets used goes to the customer. So we have indicators of control here. The entity has present right to receive payments for the assets. That's one indicator. The customer has legal title. Another indicator of control. The customer has physical possession. That's the third indicator of control. Then the customer has significant risk and reward of ownership of the assets. As the fourth one, the customer has accepted the assets. That's to tell you that the customer, as the government now, is now in control of the assets. And when goods or services are transferred continuously, appropriate measurements of revenue include, we have the output measurement. That's unit produced. You do it per unit produced, unit delivered, contract milestones, surveys of work performed. Then input method, it also have the cost incurred per unit of cost incurred. You divide it by the unit of cost incurred when it is continuous. Then labor hours expended, machine hours used. So contract cost, and it says the incremental cost of obtaining a contract must be recognized as an asset if the entity expects to recover this cost. However, those incremental costs are limited to the costs that the entity would have incurred if the contract had not been successfully obtained, e.g., success fees. Now, the success fees to agents is an example, and it would not be paid if the contract was not gotten by the company. It's just like a tip to the agents for doing a good job. A practical expedient um, a practical expedient is available, allowing the incremental cost of obtaining a contract to be expensed if the associated amortization period would be 12 months or less. Costs incurred to fulfill a contract are recognized as an asset if if only if all of the following criteria are met. First is the cost relate directly to the when do you recognize the cost of the contract as an asset? When it is related the cost of the contract as an asset, when it is related directly to the contract. The cost, then when the cost generates or enhance resources of the entity that will be used in satisfying the performance obligation in the future, and the costs are expected to be recovered. Those are the three conditions there. This includes, now we are giving examples of those costs: direct labor, direct materials, direct labor used in, say, the construction of the bridge, direct materials used, and allocation of overheads that relates directly to the contract. The assets recognized in respect to the cost to obtain or fulfill a contract is amortized on a systematic basis that is consistent with the pattern of transfer of goods or services to which the asset relates. Now, presentation in financial statements. Contracts with customers will be presented in an entity statement of financial position, normally as a contract liability, a contract asset, or a contract or a receivable, depending on the relationship between the entity's performance and the customer's payments. Now, contract recognition falls basically within these three areas: contract liability, contract assets, and receivable. Those are the three areas it affects. And first, a contract liability is presented in the statement of financial position, obviously the liability side, where a customer has paid an amount of consideration prior to the entity performing by transferring the related goods or service to the customer. So if the government pays the amount for the bridge to the construction company before it builds the bridge or it starts building the bridge, then that amount should be recognized as contract liability by the construction company, because it has not delivered the bridge yet to the government. So it's basically owing the government that money. Then, where the entity has performed by transferring a good or service to the customer, as the government, and the customer has not yet paid the related consideration, a contract asset or a receivable is presented in the statement of financial position. Now, this is basically the opposite of the former. Now, the company has built the bridge but still waiting for the government to pay it the amount of consideration for that bridge. And it says a contract asset is recognized when the entity's right to consideration is conditional on something other than passage of time, for example, future performance of the entity. A receivable is recognized when the entity's right to consideration is unconditional except for passage of time. Contract assets and receivables shall be accounted for in accordance with IFRS 9, and any impairment relating to contracts with customers should be measured, presented, and disclosed in accordance with IFRS 9. any difference between the initial recognition of a receivable and the corresponding amount of revenue recognized should also be presented as an expense, for example, an impairment loss. So we move to the disclosures. The disclosure objective stated in IFRS 15: for an entity to disclose sufficient information to enable users of financial statements to understand the nature, amount, timing, now the nature, the amount you disclose it, the timing, and uncertainty of revenue and cash flow arising from contracts with customers. Therefore, an entity should disclose qualitative and quantitative information, qualitative in form of notes, quantitative in form of calculations, information about all of the following. First, its contract with customers, significant judgments, changes in any judgment made in applying the guidance to those contracts, and any asset recognized from the contract to obtain or fulfill a contract with a customer. An entity should aggregate, that's add up, or disaggregate, that's separate disclosures to ensure useful information is not obscured, it's not covered up, it's not clustered, it's made public, clear. So basically we are done with today's class. I hope you learned a lot. Thank you.